Good evening, ladies and gentlemen. We're just sorting out just one technical glitch. I'll be with you guys shortly. We'll be having the video cam up and running just shortly. Okay. My name is Calverwell. I'll be the one taking you guys through FM303, our first online tutorial for second semester 2017. Just to get some heads up from you guys, are you hearing me clearly wherever you are? Oh, great stuff, Carla. So I could actually see a multiple of you guys responding. Oh, great. So I'll be the one taking you guys for FM303 as we are trying to prepare you guys for the assignment, which is due on the 15th. Okay, Moseli, pertaining the video, Genevieve will be in a position to help us in no time. Oh, great stuff. Whilst we're waiting for that to be sorted, let's move with our online tutorial. So I'm quickly going to do an overview of the module itself. Immediately after, we then have to look at the assignment that will be due in just above 2 weeks' time. If ever you've got specific questions, I will be glad to help you out, but let's be specific. And I would be expecting you guys to be interactive throughout the whole time. So just a quick overview of Unit 1. Unit 1, the topic says marketing is equal to shareholder value creation. One needs to go through, as you know, we don't have a textbook, but rather we have got a learner guide, and I can actually give you some assurance that the assignment that you're writing, the concepts, they are all covered in the learner guide itself. It will be just a matter of application, which is exactly what is expected of you at this level. Remember, FM303, according to SAQA, is gauged at NQF level 7. So there is some insight that is required of one, and also how to respond to questions at such a high level. I'll then quickly get to marketing is equal to shareholder value creation. So one is expected to know, or rather to justify, how does marketing add value to a company, or how does marketing increase the value of a company? So the first thing that one needs to know is what is it that we refer to as shareholders' wealth. So if I can give my own definition of shareholders' wealth, I would say shareholders' wealth, it is the total value that is associated to any shareholder, and it is indicated on the market share price of that specific company, and also is indicated on the receipts of dividends. That's what we refer to as shareholders' wealth. So one is expected now to then articulate how does marketing influence or result in shareholder value creation. So we've got three methods in actual fact that one can use to justify that marketing will result in shareholder wealth creation. The first one is the free cash flow valuation model. The free cash flow valuation model, it is based on the concept that says the value of a company or the value of any given asset is equal to the total present value of all future expected cash flows. I'm sure you would remember when you were doing FM202, when you're calculating the value of an asset or the present value of an asset, you were discounting all future values, trying to bring them to today so that you would know the value of an asset. So in short, the value of an asset according to the free cash flow valuation model, it is your NPV in short. which is the total present value of future expected cash flows that one will get from a specific project. So that's your free cash flow valuation model. So when you're linking up now, how exactly does marketing influence shareholder value creation? In your learner guide, if you go to page 29, in actual fact, it gives you more of an illustration, but what is expected now is how you actually articulate the connection. If marketing is done properly and efficiently, it goes without saying we would expect the sales revenue of a company going up. Once that happens, we expect also what we refer to as free cash flows, which are cash flows that are not tied to any obligation of an organization to go up, which will then be followed by an increase in a share price. Like I've defined shareholder wealth, I say it is the total value associated to any shareholder which is indicated on the market share price. So when the share price has gone up, one would have actually maximized shareholders' wealth. So of importance is to bring in the concept that marketing does actually affect sales revenue. And then if you look at your balance scorecard, we have got 4 perspectives there: the learning and growth perspective, the internal business processes, the customer perspective, and also the financial perspective. The balance scorecard has got leading indicators, which are the first 3. If you go to your textbook on page, not your textbook research, but your learner guide on page 35, it would actually articulate what is it that we refer to as learning and growth. How does it then connect to internal business processes and also the customer image? So in short, the learning and growth, which give a company a cutting edge or a competitive edge over its competitors in the very market. For one to be in a position to achieve that, you need an innovative product. And who brings products in the market? More or less those that are innovative is marketers. So it is the role of marketers, a pivotal role, if I would put it across like that, that will bring an innovative product that creates value for the customers so that they'll be in a position to buy. So once you have created value because of the innovative product at learning and growth, you then need internal business processes that supports your product. If that is being done properly and the support is efficient, it is going to affect the customer image, the image that customers have on the product and also on the organization as a whole. Once once the customer image has been enhanced, me and you then would agree that we would be expecting more customers to buy. And once more customers are buying, that is going to result in a financial performance, which will then connect to the financial perspective itself. So the balance scorecard, which marketers play a strategic role in, will eventually maximizing shareholders' wealth, if it's done properly, of course. And then the customer value added model, the objective here is if you increase the customer value by justifying why customers should spend a little bit more on the services that they'll be consuming, and at the same time trying to reduce or decrease the variable cost of producing the very products or services, one will be in a position to maximize shareholders' wealth. So it is the role of marketers that plays a pivotal role pertaining the perception that customers have on our product or on the institution itself. So the 3 models can actually help one to articulate that yes, marketing would actually result in shareholder value creation or shareholder wealth maximization. So that's basically what Unit 1 is. And then Unit 2 is looking at focusing in the marketing environment. 65% or rather 65 marks of the 100 in your assignment is coming from Learning Unit 2. If I can just quickly talk around what is it that it includes. It would want one to understand what is it that we refer to as forecasting. And when you're looking at the forecasting itself, one would actually try to put it across in a layman's terms by saying forecasting, it is a financial plan. When you're making a forecast, you're trying to look into the future. It's forward looking. Something that I would say almost all of us on a personal level will do. Just that now when you bring it to a business environment or context, the interpretation still remains the same, that just that it will be on a deeper level. So forecasting is when one is trying to make a financial plan into the future. You can't be running an organization without knowing what is it that is need to be achieved in future. And then they also want you to know the forecasting process. In your learner guide, in actual fact, you have got the process being illustrated on a diagram. The first stage being gathering of information, the second stage or step 2, which is compiling a forecast. Step 3, you then monitor the forecast versus the actual results. At that stage, you'll be taking corrective measures if ever the forecast is going off track to what is it that would have been budgeted. And then step 4, one is going to be looking at if ever new information comes to light, you need to bring in that new information so as to keep your forecast relevant. So that's basically your forecasting process. Tools that one can use in forecasting. We're going to look at your trend analysis. You will be comparing what has been happening, especially on sales volume. How much have we been selling over time from one year to another? So if you then say, let's say if I can give an example, if we have sold 1,000 units in year 2017 and maybe 500 units in year 2016, if I want to look for a trend, I'll end up saying the new 1,000, subtract the 500 we started with, which is the best year, over the 500 itself. It will give you a trend at which sales volume will be increasing at. Your regression and correlation is just trying to give you a relationship between your independent variables, which is denoted by X, and your dependent variable, which is basically Y. So when you're looking at regression and correlation, we are looking at the straight line relationship between X and Y, which you guys would have done when you're doing learning in your first year. Straight line equation is equal to Y is equal to mx plus c in short, which can also be expressed as Y is equal to a plus bx. So that's basically your regression and correlation, trying to give a relationship. If I would then bring it to marketing, one will be trying to get the relationship between money that is spent in budgeting versus the sales that one will be expecting to achieve. So the normal assumption is the more money we would spend towards marketing activities, we would actually want to have more sales volume as a result of such. So that would be your regression and correlation. Sensitivity and scenario analysis, I actually saw it also in your assignment. Sensitivity analysis would want to see if specific variables, especially variable cost, if they will change, what will then happen to the project? We would have initially accepted a project looking at the information that you have at hand. But then the minute specific variables change unexpectedly, we would want to test and see, is the project going to still remain viable or acceptable over time? And then your scenario analysis, you will hold all other factors that affect your project constant and only bring a specific factor and then bring it in and try to test if the project will be acceptable if the pessimistic position happens or if the optimistic position happens. So you'll be looking at your worst case scenario and also at your best case scenario. So that's basically what is expected of one when you're looking at learning unit 2. Learning unit 3 is the pricing decision. One is expected to define or just to understand what is it that we refer to as price elasticity of demand. The relationship between those, we are looking at price and the quantity demanded. So there is an inverse relationship between evening K. You haven't missed much. I'm just quickly doing an overview of the units that you have for the module. And then in no time, we'll try to look at the assignment and help you out, maybe rather give you hints on how to respond to some of the questions in there. So I was looking at price elasticity of demand. You're welcome. There's a negative, or rather I would say there's an inverse relationship between increases in prices and quantity demanded. The magnitude of the change now on your quantity demanded is what then you end up bringing concepts like, is this product elastic or is it inelastic? One is expected to calculate and describe the PED of a product. You need to look at the ranges to say if PED of a product is more than 1, what does that mean? If it's less than 1, what does that mean? And then also, one will also be expected to know at which level would demand for a specific product maximize the profits of a company. And then finally, one is expected to evaluate, then discuss product pricing strategies, where you've got your price skimming, penetration pricing strategies, and so forth. So that's basically learning unit 3. In your assignment, it has got 15 marks. We're going to have a discussion on that. I'll quickly do a rundown on unit 4 and 5, because our objective for today will be looking at especially unit 1, 2, and 3. That encompasses your assignment. Product and customer profitability. In short, this topic is going to talk around or helping one to make decisions on which specific products should we invest more money because they are giving us more profits, and which ones should we put limited resources because the company is always constrained when it comes to financial resources. So a company could be selling a product. You then conduct what you call product analysis, product profitability analysis. And if a company sells a service, you end up conducting what you call a customer profitability analysis. And then those two scenarios of one company selling products, you then interpret the product profitability analysis using the BCG metrics. You guys are marketers, you know that concept very well. The dot section, the question marks, and so forth. And then if you are selling a service, one will also then do interpret the scenario that you would have calculated using the four box module. So in short, unit 4 talks around, or it helps one to try to optimize the limited resources companies have by putting more of your resources in products or in services that will be giving companies more profits than not. And then unit 5, which will be the last one, one is expected to look at marketing strategies and also strategies pertaining projects. We'll be conducting what we call a cost-benefit analysis. You'll be making a decision pertaining the cost you are incurring versus what is it that we are going to expect as benefits from incurring a specific cost. So if ever your cost outweighs your benefits, there won't be any need for one surely to pursue such a project. And then quantifying your marketing strategies and also conducting your brand valuation. So important. If I'm not mistaken, I'm sure you actually have got a module called brand management. An individual is a brand, companies and the product that they sell. Brand equity is of importance, and it needs to be calculated, especially now that we'll be doing financial management. I'm sure we'll discuss more of that as we prepare for the exam. So that's basically a quick overview of FM303, looking at the 5 learning outcomes that we have. Are there any specific questions, guys, on the overview we just did? And in no time, we'll then start to discuss the assignment itself. I won't be giving you solutions as such, but we'll discuss the assignment. I can enlighten you in specific areas that look confusing. How is that, guys? Should we get into the discussion of the assignment? If you can kindly make an indication, so we'll be in a position to move. So I can imagine the edge of trying to look at the assignment itself, but of course that's the purpose of this online tutorial. Great stuff. So let's have a look at the assignment. I'll quickly read some of the questions that we have here. Well, thank you guys. And then give an overview of what is it that is expected for one when you respond to these questions. So question 1 that comes from Unit 1, and the topic is marketing is equal to shareholder value creation. I hope everyone have got their assignments next to them. So I'll get into question 1.1 just to give you an overview of what is it that is expected of one. So part A says, in the past year, a shareholder in a listed manufacturing organization has achieved a share price gain of 120 rands and has received dividends of 8 rand per share. Then the question then says, discuss what this means to the shareholder with respect to shareholders' wealth. I think the first thing that I did when we started, I defined what shareholders' wealth is. So when you responded to this question, the first thing, if you look at the question, I'll read again, it says, discuss what this means to the shareholder with respect to shareholders' wealth. So you need to define what shareholders' wealth is first, which is also found in your learner guide. And I've defined shareholder wealth as the total value that is associated to any shareholder, and it is indicated or it is represented by the market price of a share and also on the receipt of dividends. From that definition, you would actually be now in a position to go and articulate what does the 120 mean, and also what is it that we refer to as the 8 dividends, the 8 rand dividends. And the combination of the two will give what we call a shareholder wealth or shareholder value. So that's basically how one is expected to respond to such. But make sure you bring the definition first and then bring the figures according to how you would have defined shareholders' wealth. Question 1.2 says, explain how marketing may have contributed to this increase in shareholders' wealth. The very increase of 120 plus 8, which will give you 128, we call it shareholder wealth has increased. And remember, Unit 1, the topic says, marketing is equal to shareholder value creation. I've spoken about 3 modules, the free cash flow module, the balance scorecard, and also the customer value added. You need to bring in the impact that marketing had using those 3 modules to justify that yes, marketing would actually influence or will help out in increasing shareholders' wealth maximization. So bring in the 3 modules that we have there. But don't put a lot of words, go straight to the point, but pay attention to the marker location in this regard, which is 5. Part B. Part B says, with reference to an online shopping organization of your choice, meaning you need to actually go and look for an online organization. You're not going to generalize this question. Look for a specific company of your choice. A good example could be Spree, and you guys, you can choose whichever that will suit you well. So you pick an online organization, that's the first thing. Discuss 2 ways that the company can measure its achievement of the customer perspective of the balance scorecard and why these are important for increasing brand equity. Indicate the customer-related metrics that can be used in each question or in each case, sorry. So remember, I spoke of the balance scorecard, and in actual fact, it's illustrated on page, in your learner guide, it's on page 35. The customer perspective, in short, the focus is on how the company views or how the company, so how the customers view an organization or a product. Or one can put it across as the customer perspective to balance scorecard contains itself with the customer image on a product or the customer image on the organization. The image itself gets influenced by the first 2 stages to your balance scorecard, which are learning and growth, and also the internal business processes. So you need to articulate that part first, And then they've combined this question with Unit 2. So the balance scorecard, and to be specific, we are zeroing in on the customer perspective. It's Unit 1. And then the customer-related metrics that we are referring to, one can actually go to page, it falls under Unit 2. If you can go to page in Unit 2, let me just quickly go there, I'll tell you what page it is. If you go to page 107 to page 109 in your learner guide, you're actually going to find out we have several customer-related metrics there. Go and pick out 2 customer-related metrics that talks in line with customer perspective. I'll give an example. The very first one that we have on page 107 is customer satisfaction. So that talks around the image that customers have on an institution. But remember now, you're not going to pick these metrics without looking at what is it that is exposed by the company or the online organization of your choice. So look at the online organization of your choice. Look at what metrics, 2 of them, are talking directly to the organization. And then once you have picked those, name the metrics, give a short description, which is also given in the learner guide on page 107 to 109. Give the formula as well because you're looking for marks. And then bring relevance to the very metric you would have chosen, or the 2, to the specific scenario that you're having on the online organization of your choice. That would actually then fetch you 12 marks. So that's what is expected on question 1.3. The customer perspective, the balance scorecard, gets influenced, or it depends on the first 2 stages of your balance scorecard, and then bring in any 2 metrics that talks directly to customer perspective from page 107 to page 109. And then in conclusion, you should also say how does those 2 metrics influence or help to increase brand equity. So in short, that is basically question 1.3, and in total that is question 1. I don't know if there are specific questions on question 1, guys, or if there's any clarity that is required there, which I can actually have a look now before we move on to question 2. I can see Ellie is typing, and my assumption will be if there are no people typing, it means we are okay, we should move on to Unit 2. Oh, great stuff, okay. Ellie is still typing. Let's give her a few seconds and see her input, and then we'll address that and we'll move. The company doesn't have to necessarily achieve customer perspective early. If they have, good for you. Even if they haven't done that, you then say, you know what, their customer perspective metrics, they are very low because they're not doing 1, 2, 3. Remember, the customer perspective that we need to bring here is the image. So an image could be a good image, or it could be a bad image. So a bad image, of course, is going to influence or affect your brand equity negatively. So it can go either way. Or great stuff, Ellie. So we'll be in a percent to move on. And then, can you go over question 1.2 again? Question 1.2, you need to define what is it that we refer to as shareholder as well. So that was question 1.1. Question 1.2, because we have already defined what is it that we refer to as shareholder as well on question 1.1. What you then need to do there is, how is it that marketing can actually influence the shareholder wealth creation or value creation? So you use the 3 modules that we have. They are articulated in detail in your learner guide as well, which is the free cash flow module, the balance scorecard, and also the customer value added. But of importance is bring out what is it that marketers do when you're looking at free cash flow model, which eventually does affect your share price. When your share price has gone up, one would have maximized what we call shareholders' wealth or shareholders' value. I hope I have responded to you there, Ekaversion, and I'm hoping I actually pronounce your name very well there as well. So I would wait for a response or for his response. In the meantime, I think let's go and have a look at question 2. Question 2 just got 65 marks. It's important for one to pay attention to the grammar, how events are taking place, because me and you know time value of money when you're doing unit FM2. How events takes place does affect our expected cash flows. It's either that we're expecting to pay or expected cash flows that are supposed to be received. So moving on to question 2. You have been given a case study there about a company called Brilliant Brands Limited, abbreviated as BBL. This company, traditionally or of late, or all this long, this company has been providing advertising services to organizations in the financial sector. They've done a research and find out that there is a digital marketing services opportunity which has got 400 million market to be served, which is going to increase at 25% per year. So just to give a quick context, in my own words, the scenario you have here, BPL is providing advertising services to financial institutions. They are deciding to move into also providing digital marketing services, but we need to project or to forecast what is it that is going to happen once they adopt the digital marketing services. So because the plan here is they actually want to implement, or rather we are going to do a forecast of bringing in the digital services component to this company at the beginning of January 2018, which becomes basically my first year of my projection. We are in 2017, the projection is to move from 2018 onwards for a period of 3 years. Now, if they do bring in, or if they choose to adopt the digital marketing services, there are going to be synergic effects which are going to create or which are going to result in an expected once-off increase in traditional advertising sales of 30 units. Over and above the normal 5% growth rate in advertising services. Rather, let me read this statement word for word. It says, I'm reading the fourth paragraph, just underneath the following information is available. It says, with the introduction of the digital services, BPL becomes a full service agency, and the synergic value created by the new division is expected to result in a once-off increase in traditional advertising sales of 30 units over and above the normal 15% growth rate in advertising sales. So in short, the sales figures for traditional advertising will continue to increase at 15% from 1 year to another. We'll only be having a windfall or just a once-off increase of this traditional advertising only in 2018 of 30 units. From then on, it will proceed at 15%. So that's what that statement would mean. They even went on to try to clarify this statement by saying the paragraph just underneath that. All BPL sales volume are expected to grow subsequently at a rate of 15% per year. Note, this increase must be based on what the 2018 sales would have been without the additional revenue from the 30 units. So in 2018, you're actually going to have a normal 15% increase, which will also move from 2018 to 2019, 2019 to 2020. But specifically in 2018, you're actually going to have another additional 30 units, which is coming around because of the synergic value of combining these two services. So that's one. They went on to give you historic revenue pertaining BPL. In 2017, they were selling 220 projects. Of course, these are your normal advertising services. 2017 it was 200, and 2015 they were 150. I'm interested in this statement just to clarify it. It says, just underneath the tables that we have pertaining traditional advertising projects, it says, the gross margin for traditional projects in 2018 is expected to be 19%, with digital projects expected to achieve a gross margin of 40% in 2018. Important note, this is gross margin and not markup on cost. The difference of the two, if you actually write in the formula of gross margin is equal to profit over selling price times 100%, or rather times 100. Markup, markup, it is profit over your cost price or your cost of sales. So in this regard, this statement in short is saying your contributions, which are basically your gross profits, if you are looking at traditional advertising projects, they are going to be 19% of your sales. Are we selling a product here? No, we are going to have what we call project fees. So if you are working out your contributions for traditional advertising projects, your contributions are going to be 19% of your project fees. And if you're now doing the digital projects, your contributions, which are basically gross profits, are going to be 40% of your project fees. So let me just clarify this thing of project fees. When you're selling a product, a physical product, we then call that in finance sales. But whenever you're selling a service, we end up calling it maybe services rendered income or services revenue, or in this regard, we are calling it project fees. So the money that we get or the revenue we get, because we are offering these advertising services or digital advertising services, one is going to get what you call a project fee. So let's not interpret the fee as if it's an expense, rather that becomes our income or our source of revenue when you're offering a service. So that is that pertaining gross margin. Your contributions for advertising projects are 19% of your project fees. And also, if you're looking at digital projects, your contribution, which is in short gross profit, are 40% of your project fees. So that is it pertaining your gross margin and not the markup. They went on to say, on page 4 of your assignment, it says, the marketing budget for both services in total is 22 million in 2018. Of this, the 22 million, 15% is to be allocated to marketing the new digital projects. So it goes without saying, the combined marketing budget for 2018 is going to be 22 million. If you want to single out the portion that then goes to new digital projects is going to be 15% of the 22 million, and of course the 85% will fall under your traditional advertising. The last paragraphs, I think it's important for me to read through and also give clarity to them. It went on to say, the case study says, BPL variable cost consists primarily of staff cost. You can imagine a company that is offering service. We are not offering products here. Your staff costs, which are basically your salaries and wages, are going to be the major or the biggest component of your variable cost. So BPO variable cost consists primarily of staff cost, which are basically salaries and wages. Salaries for advertising staff are expected to continue to increase by 8% per year. Digital marketing staff are to be hired at the start of the new venture in 2018. Because the initial salaries will be much higher than those offered by the market, their salaries are expected to increase by only 7% per year. So variable cost for your traditional advertising are going to increase at 8% per year. And then variable cost for your digital services will increase at 7% from one year to another. Project fees, look at this. Project fees and all expenses other than staff cost, remember your staff cost in this regard are your salaries or your wages. I'll read the statement again. Project fees and all expenses other than, the term other than, it means with the exception of, staff costs in this regard, which are salaries, which are our variable cost, are budgeted to increase annually by the inflation rate of 4%, meaning my marketing budgets are going to increase at 4%. My project fees, or the revenue that we're getting from both the projects, are going to increase at inflation rate of 4%, with the exception of your variable cost, because your variable cost are primarily made out of your staff cost. In short, they are your salaries and your wages. So those will be increasing for advertising projects at 8%, and then for digital projects at 7%. And then the question went on to say, during year 2017, 6 million has been spent on the establishment of the new service. So this is money that has already been spent. Spent when? In 2017. So it's a capital expenditure we're incurring in year 0, which is basically before the launch itself in year 0. These establishment expenses will be capitalized over 3 years and are tax deductible. The term capitalized, it means we're going to spread them equally over the 3 years, meaning 6 million divided by 3 will give you 2 million in 2018, 2 million in 2019, and 2 million in 2020. But don't forget, we would have also indicated the 6 million in year 0, which is now in 2017, as an outflow. The element of tax deductible is going to give birth to what we call a tax shield. If you remember well when you were doing FM101, when you're preparing an income statement, you would say sales less cost of sales gives you gross profit. You add another related income, you subtract expenses. You get your profit before tax. You then bring in the tax. You get yourself your net profit after tax. So they are telling you that the establishment costs that have been incurred initially in year 2017 are going to be spread at 2 million, 2 million, 2 million, respectively from 2018 to 2020. They are a tax deductible expense. By virtue of you having an expense reducing your income from your gross profit, you are going to benefit from what you call a tax benefit, because instead of you being taxed at gross profit or at gross profit plus any other income that you have earned, in actual fact, the tax is going only to apply after we have subtracted these expenses. So your 2 million is going to give you a tax benefit, which we are also going to look at when I'm going to look at the format that you have that has been provided. The company weighted average cost of capital, which is what? You are going to use the 14% as a discount rate when you're calculating the NPV. The corporate tax rate is at 28%, which is basically the normal tax rate companies are taxed at, unless you are told otherwise. So if you move on to part A now. So what we've done is just to do a quick overview of what the assignment, the case study is. It's a company that was offering advertising services. They want to get into offering digital services to their clients so that they become a full-fledged service company. There are going to be synergic effects because of bringing these two services together. They are supposed to spend a total of 22 million in 2018, which needs to also escalate at 4% moving into the future. So that's basically the decision that one needs to make to say, is it going to be viable for this company to get into this market of offering digital services? And what will be the overall effects to the company as a whole? So if you then look at part A, question 2.1, it says, identify for the digital services division. So they are singling out the digital services division. One example that relates to each of the 4 dimensions of quantitative information. Justify your answer. The format of your answer should be dimension, example, and justification. So our 4 dimensions of quantitative information in your learner guide are found on page 73. We have got these 4: value, timing, volatility, and relevance. So you're supposed to read through the case study, name the dimension. So by virtue of you naming the 4, it can give you 4 marks. If you look at the way that they want you to respond to this question, is the dimension followed by an example. Pick up an example that talks directly to these dimensions or the specific dimension you would have brought, and then give a justification why the example you're picking falls under the very dimension you picked. So that's basically would fetch you 12 marks. Question 2.2 then went on and said, forecast the demand, which is the number of projects for each of the years 2018, 2019, and 2020 for BPL traditional advertising services. So we are also specifying which forecast or which service are you going to do this forecast on. If you flip back to your case study itself, we know in 2017 we sold 220 projects. And if you then read the statement I read, just underneath the following information is available, or maybe the last sentence of the following information is available, it says, with the introduction of the digital services, BPL becomes a full service agency, and the synergic value created by the new division is expected to result in a once-off increase in traditional advertising expected when in 2018 is going to result in a once-off traditional advertising sales of 30 units over and above, meaning we're supposed to have your normal 15% increase. On top of that, we are only going to have a once-off of 30 units in 2018, and then you'll be in a position to do your projections. So that wording and how the events are taking place, the 15% is going to move from one year to another. Just that in 2018, we are going to have an additional 30 units going to be sold as a result of the synergic effect of this company bringing in the digital services division. So that's basically the wording that one needed to pay attention to when you're responding to question 2.2. Maybe before I'll move on to question 2.3, are there any questions on question 2.1 and question 2.2? And then we'll be able to move on to question 2.3. I can see LM is typing. Oh, great stuff. Seems as if all is good for now. Let's move on to question 2.3. It says, using your answer from question 2.2, look the knock-on effect that this question 2 has. You get figures wrong in question 2.2, it's going to make your question 2.3 onwards wrong. But my assumption will be you guys are going to get question 2.2 correct from the onset. So using your answers from question 2.2, forecast the total contribution for the company. And it's stipulated for the company, meaning the total of the traditional advertising contribution and also the contribution you are going to make from your digital services. Use your answer from question 2.2, focus the total contribution for the company after marketing expenses have been taken into account for the next 3 years, 2018, 2019, and 2020. A suggested format is provided below. I'll then give you an advice. The very suggested format does make sense. Use it. I gave you 2018, 2019, and 2020. I want you to calculate your traditional project contribution first before marketing expenses. Move on to traditional projects contribution, digital projects contribution before marketing expenses. Then bring in the total contribution you would have made from both the two projects. Only then would you then bring your marketing expenses of 22 million. In 2018, you start to escalate it at 4%. So the average fee per project, if I'm looking at traditional projects, they have told us on page 3, or where the case study started, it says, just on top of the table that we have for traditional advertising projects, it says BPL expects to complete 60 digital projects in 2018. They're expecting this because, remember, they're going to launch or to introduce the digital projects in 2018. So they're expecting 60, increasing by 15% thereafter. What is this increase on the digital projects only? That 15%. The average fee for a digital project is estimated to be 250,000. So one project will give you a revenue of 250,000 in 2018. How many projects for digital are you going to implement? 60. Me and you would know when you now do the projection for digital services, you're going to do the multiplication for 2018. Then my concern here for now, it is the traditional advertising projects are currently achieving average revenue of 1.6 million per project. So currently when? In 2017. And there is a statement on page 4 that says project fees, which is basically where my 1.6 million of 2017 falls into. And all the expenses except for staff costs are budgeted to increase annually by the rate of 4%. Surely one is going to escalate your 1.6 million fee for 2017 times 1.04, which is the inflation rate, to get your average fee for 2018, and you continue to escalate it at 4%. Your variable cost, that's where the catch is. Your variable cost per project. Your variable cost per project, you're going to get it as you actually, in actual fact, you needed to solve more of an algebraic equation there. They gave us a statement pertaining margin. I've spoken about that. I say, if you read the statement right at the foot of page 3, it says the gross margin for traditional projects in 2018 is expected to be 90%. So after you've escalated your 1.6 at 4% at times 1.04, you get your average fee for 2018. 19% of that will be a contribution per project. The difference between your average fee and your contribution per project will give you a variable cost. The very variable cost you are going to escalate now at what? At 8%, as stipulated and indicated on your second paragraph of page 4 that says, BPO variable cost consists primarily of staff cost, salaries, which are basically staff cost. For advertising staff, are expected to continue to increase by 8% per year. So once you have got your figures of variable cost in 2018, you escalate the figure times 1,08 moving into 2019, times 1,08 moving into 2020. The difference between your average fee and, of course, your contribution, and your variable cost now, will then give you a contribution. Number of projects sold. Number of projects sold, you are going to get your number of projects sold from your question 2.2, where you would have escalated your 220 at 15% in 2018 plus the 30, and you also continue doing so. So the number of projects, we sold 220, increase it by 15%, add the 30 on top. You get the number of projects in 2018, and then you also move on to 2019 and 2020. But pay attention to your 2019 and 2020. It should include the 30 because the 30 were only once off in 2018. If you multiply your number of projects to your contribution per project, it will give you a total contribution. You're going to do exactly the same when you're going to look at your digital projects. But pay attention, your digital projects in 2018 will give you 250,000 revenue. And how many projects were you expecting in 2018? There were going to be 60. But then from then on, your projects are going to increase at 15%. So you need to bring that into effect. So the flow will move exactly the same for your digital project, just like what you would have done for traditional projects. So what you're going to end up with, you end up adding your total contribution from traditional projects plus your total contribution from digital projects. It will give you your total contribution before marketing expenses. The total contribution will be for the entire company, coming from the two projects that will be running. Only then would you then subtract your marketing expenses. Your marketing expenses, they told you they were going to be 22 million in 2018, and then all fees. Remember, your marketing expenses in this regard were your expenses. So it actually falls under your expenses. They're supposed to increase at what rate? At your 4%. So you say times 1,04. That will give you a marketing expenses line. Total contribution for the company minus your marketing expenses should give you a total contribution after your marketing expenses. So that's basically your question 2.3. I can see Marcel is typing. Are there any other questions that one should clarify on that? On question 2.3. Marcel is typing. Whilst you're still waiting on, please explain how one calculates total contribution before marketing expenses. Okay, your total contribution before marketing expenses, you are going to say total contribution from traditional projects before marketing expenses plus total contributions before marketing expenses from digital projects. That will give you the total contribution for the entire company. So that's how you calculate your total contribution for the entire company, Marcel. Carla is saying, so we show all these calculations separate from the table. You know, just to play safe, I would actually do so, especially whenever I'm doing these escalations, when I'm increasing figures from one year to another. In case I end up making mistakes in putting figures on the table or the format that is given, I would actually try to show important workings like your variable cost and your contribution calculation. I can just have it just underneath the table itself. Okay, there are multiple of your colleagues typing. That's right. You just need to label it correctly and let it flow so that one will be able to follow what's going on in case you end up making calculation mistakes. You're welcome, Carl. Marcel is still typing. Let's see what he's saying, or we'll be able to move on to question 2.4. The actual calculation or the projection of your relevant cash flows and thereof the calculation of NPV. Okay, I mean the one in traditional projects. Okay, your contribution from traditional projects, you are going to say the contribution you would have got for year let me just talk around year 2018. Remember, your average fee was that 1.6 million times 1,04 to give you the expected fee per project in 2018. Then you say 19% of that will give you a contribution. The difference of your average fee subtract your contribution per project will give you a variable cost, of course. If I continue going down with 2018, you then say, what are the number of projects solved? Remember your calculation on question 2.2. When you're escalating, when question 2.2 says, focus the demand, which are the number of projects for each of the years 2018, 19, and 20. The figures that you got on question 2.2, you bring them there as your number of projects solved. I will then say contribution per project multiplied by number of projects solved. That should give you a total contribution before marketing expenses for traditional projects. You then go do exactly the same when you're calculating the total contribution before marketing expenses for digital projects. You're welcome, Marcel. And then question 2.4, it needs one to calculate your NPV. I'll quickly read what the question says. It says, calculate and explain whether the NPV of the forecasted additional contribution made by the digital services division only, which you have calculated in question 2.3, is accepted. Remember to include the marketing expenses and also the establishment cost. Before you would respond to this question, I would suggest in your learner guide, try to go through example 2.7. It's going to give you explanations pertaining how to calculate your tax shield. In actual fact, there are two methods there, method 1 and method 2. This is the second method that on example 2.7, that would actually give you an indication on how you're going to treat your tax shield on this question. So that example 2.7 in your learner guide, let me just quickly make an indication so one would know where it is. It's on page 89. Go through that question. You will be in a position to pick up what is it that we refer to as relevant cash flows, which one then use to calculate your net cash flows. So we are going to bring in your contributions that you have calculated on question 2.3. The only tricky part on this question for me, I think, is the marketing expenses. It says, bring in contribution that you have calculated on question 2.3 only for digital services. You have those on your first line. Just underneath that, you have got your marketing expenses. The marketing expenses for the digital services are only going to be the 15% of your 22 million, not the whole 22 million. The whole 22 million was for the entire institution, which also included the 85% for traditional advertising. So you needed to take only the 15% of the 22 million, have it in year 2018, and then you start to increase it at 4%, meaning times 1,04. And then you should be in a percent to work this calculation going downwards. Pay attention to method 2 on example 2.7 on how to treat your tax shield. And then question 2.5 says, BPL is concerned about the digital services division variable cost, which are basically your salaries. Expert employees are difficult to source, and the company is worried that the budgeted annual salary increases of 12% will be insufficient. The company is thinking they are going to incur salary increases of 12% in the future, and they are worried that if that happens, maybe the project might end up not being profitable or not. Then the question says, calculate the sensitivity of this variable cost relative to the NPV and explain your answer. This is what you call a sensitivity analysis. I will then also want you guys to go through, there's an example in your learner guide pertaining sensitivity analysis. Should be example 2. Sensitivity analysis, example 2.8. In short, what sensitivity analysis is, one is saying, under these circumstances, if our variable cost changes, will the project still remain viable? By viability, I mean, is our NPV still going to be positive, or is going to be negative? So if you do that calculation, in short, you're going to redo your NPV calculation, but now bringing in the sensitivity, and you have got a formula of calculating variable cost sensitivity in your learner guide. It is, let me just quickly show you what page it is. It is from page, that is scenario analysis, page 103. Page 103 will give you more information pertaining how to calculate your sensitivity analysis. But in short, what we're trying to achieve or to arrive at is, if this variable cost will increase at that 12%, is the project going to be viable or not? So that's exactly what is expected on question 2.5. But don't forget, this is only for digital services division only. So what is it that you're bringing in? You are bringing in the variable cost, in short. Bring in your variable cost, see if you are going to be in not profitable as such, if the project is going to be way too sensitive, if this variable cost changes at that magnitude or not. That is question 2.5. Question then 2.6 says, give and explain two examples of external environmental variables that may influence BPL forecast negatively. This is an open question. It all depends. Remember, you're talking of the external environmental variables. When you did FM2, I still remember, under your elementary risk, we said we have got two types of risk, systematic risk and non-systematic risk. So the one that they are referring to here are systematic risk, the risk that emanates from the external world. So an example could be foreign exchange rate risk, or you could look at inflation. Unexpected increase in inflation can actually negatively affect your forecast. If the thinking was inflation will increase at 4%, and then things do change, inflation is now 6% or 7%, you can imagine the impact of the project itself. So it's an open question, but look at the risk that this specific company could actually be facing, and also pay attention to the mark allocation there. We've got 4 marks, meaning I need to mention the 2 and then justify why I picked those 2. Question 2.7 then says, BPL revenue budget for 2018 for the digital services division may vary by 25% either way. Either way, it means what you have achieved or the projection that you have done on question 2.4, they could actually get worse, meaning it could be less than 25%. Remember, 25% either way, it means I'm saying 100% plus 25%. That would be the best case scenario. Or 100% subtract 25% would be your worst case scenario. So that's what you call scenario analysis. And when you conduct a scenario analysis, all other variables should remain constant. When you are doing economics, that concept is called ceteris paribus. So you want to see if this project will still be viable, if the worst case scenario or the best case scenario would actually transpire. So my worst case scenario to be 100% subtract 25, then my best case scenario will be 100 plus 25%. So what is important here is you are only going to escalate your figures. The figures that you have on question 2.4, the relevant cash flows themselves, go ahead and increase them by 25% on the worst case, on best case scenario, sorry, and then on the worst case scenario, reduce them by 25%. Calculate your NPV. See if this project would actually go short left if ever such scenarios will happen. You might then want to interpret on the interpretation itself. You might then want to also see what was the sensitivity of this project, and if the worst case scenario do happen or the best case scenario actually do happen, that variation, look at the magnitude of the variation of doing very well by 25% or not doing so well by 25%. If those figures are far away from what you have calculated on question 2.4, maybe this project could be very, very risky. Then question 2.7 says, based on the scenario analysis, do you recommend that BPL still pursue the digital services opportunity? Why or why not? So it all depends on the decision one would have made after conducting the worst case scenario and the best case scenario. You should be in a position to make a conclusion. So it all depends on, are you saying why, and why would you say that? And if it's not, why would you say no, they shouldn't go ahead and do that? That is question 2.7. 2.8 then says, calculate the revenue market share for digital services for each of the next 3 years, 2018, 2019, and 2020, on the basis of the forecast you have developed, and comment on the results. Remember, I think the first paragraph of the case study itself, I'll quickly read one more time. It says, Brilliant Brands Limited, which is abbreviated as BBL, is an advertising agency that provides advertising services to organizations in the financial services sector. Market research has indicated a demand for digital marketing services of 400 million, increasing by at least 25%. So if you look at what is it that you want to achieve in Unit 2, we are going to conduct a forecast of the marketing environment itself. So it goes without saying that is the total demand. If this company will get in there, the 400 million, my interpretation is would actually happen in year 2018, and then you do the escalation at 25% moving into the future. Where can one get this formula of revenue market share? The formula of revenue market share, you can find it. Let me just quickly look in your learner guide. On your metrics, your revenue market share should be revenue market share. I'll do it you guys shortly. You've got your demand focus, market response rate, it will be on page 111 to page 110 and 112. So the formula of your revenue market share, in short, your formula is total revenue over total market demand times 100. Your total revenue over your total market demand times 100. So the figures you're going to get there are going to be percentages. So I'll read the question again. It says, calculate the revenue market share. So you do that for 2018, 2019, and 2020 for each of the next 3 years on the basis of the forecast you have developed, and comment on the results. So when you then comment, look at the revenue market share versus the growth rate. Remember, the market share is expected to grow at least at 25%. Compare the revenue market share that you get and see if the company would have actually managed to penetrate well. So you're comparing 25% versus the figures that you're going to get. That will give you an indication if the company would actually do well in this very market. And then question 2.9 then says, why is it important for BPL to use scenario analysis? It's more like you're performing what you call a stress test. You're performing what you call a stress test. If things go our way, what will happen to our project? And if then things take short left direction, what will also happen to our project? And in finance, you can't just be doing projection of projects, so projection of forecasting, only looking at the best case scenario. The worst case scenario can actually happen as well. So that is basically question 2. On the theory, or when they are saying comment on the figures that you have, make sure they are making sense. Like I said, this module is pitched at NPF level 7. What is expected there is insight to say if the market is the demand or the market share of digital services are expected to increase at a minimum of 25%. And let's say we are only achieving 6% out of it. Maybe it means there's a room for you to penetrate the market more, or it could actually be very risky and dangerous to get into such a market full-blown. So your decision making and also the insight, which you guys are marketers, you know exactly what that will mean. So that is basically, guys, question 2. So it's got 65 marks. Pay attention to how you're doing your calculations. Redo your calculations so as to prove, read, or just to confirm the figures you would have calculated. And on this projection, only when you calculate NPV should you use the financial calculator. Any projection times 1,04 and so forth, times 1,08, times 1,07. Try to use a normal scientific calculator, because it doesn't round figures off early. You're only going to round the very last figure thereon. So that is basically question 2. I'll then have a look at question 3. Question 3 says, explain the link between pricing strategy and shareholders' wealth. I've defined what shareholders' wealth is. Any total value associated with any shareholder and is being indicated on the market price of a share and expected receipts of dividends. So they want you to link pricing strategy. And I think that is more of a theory question and self-explanatory there. Link pricing strategy to shareholders' wealth. And don't forget, the components of shareholders' wealth are 2. It's your capital gain and also receipts of dividends. So it could be making more strategic sense for a company not to make profits now, meaning they won't be paying dividends, but they'll be pursuing important projects that could end up making them make more capital gain or have their market price of their share increasing into the future. So don't just have a short-sightedness conclusion here. The conclusion can also be a long-term one. The long-term one is your capital gain. The short-term outcome or the short-term return when you invest in shares could be dividends. So you can just respond accordingly, but pay attention to the market location, which are 3. And then question 3.2 then says, a leather goods brand markets 2 products. So it's a company that sells leather goods. They've got leather paces and leather wallets. The paces are priced at 550 each, meaning currently, and the wallets at 480 each. Initial monthly demand for the product in a high-income area is 400 paces, meaning that is quantity demanded, and 300 wallets. The PED for the products is 1.4, meaning your price elasticity of demand. Remember how to calculate your price elasticity of demand. You would say your percentage change in quantity demanded over your percentage change in prices should give you a PED. So in this regard, they didn't give you, in actual fact, they gave you the PED. If I read on, believing that leather goods are luxury items and not sensitive to prices, the marketing demand proposed that a 20% price increase on all its products will increase revenue. So they've already given you a denominator here, isn't it? PED given. PED is equal to percentage change in quantity demanded over your percentage change in prices. They've already given you percentage change in prices, which are 20%. One way or another, you need to actually find out what will be the percentage change in what? In quantity demanded. You just need to cross multiply, solve an equation. 1.4 is equal to percentage change, which we don't know, over the 20%. That should give you a percentage change in quantity demanded. You do the same for wallets as well. You should be in a percent to know what is the percentage change in quantity demanded whenever prices increase by 20% respectively. Advise the marketing department on whether their price increase strategy is a good idea and provide recommendations to the company on how to proceed to increase revenue. So you need to be in a percent to make a recommendation right at the end. Show all calculations, the very calculation I just spoke of, including the PED calculation for each product. PED is equal to percentage change in quantity demanded over percentage change in prices is also in your learner guide. And so include those calculations for both the wallets and the paces, indicating the total revenue increase the brand can expect if recommendations are applied. So they gave you a suggested format, and I said whatever that they are suggesting on your format, you follow it because it's going to make a lot of sense. So if I can just quickly give an example of marketing department proposal under paces. The current price of paces, they said they are 550 rands, and the current demand In the upmarket, they said they were 400. Surely I can calculate my total revenue by multiplying the two, isn't it? My after price increase. When your after price increase now, me and you know they've already told us your price increases are increasing at 20%, isn't it? You go and escalate the 550 at 20%. And then whenever prices are increasing by 20%, the solution you would have found when you calculated their PEDs to calculate the percentage change in quantity demanded, you adjust your 400 by the percentage change in quantity demanded. You'll be in a percent to see the differences in your total revenue. You do that for paces, you also do that for wallets. See if it's going to give you an overall revenue following through the format that you have. If not, and then do a recommendation. But one way or another, if one makes an interpretation that because we are selling leather items or products, we are going to increase them by 20%, and they expect the same result, surely they'll be mistaken. You're actually going to identify that when you do this calculation. So that is basically, guys, question 3. The good thing is they've given you a format to follow. One should actually do that. And then they spoke around the presentation marks and the referencing. You need to reference our learner guide. If ever you actually take word for word from the learner guide as well, do your in-text referencing. You guys are marketers, you know how best to do your referencing. Your assignment can be presented or submitted timed or handwritten, but make sure if it's handwritten, it's clear. One will be in a position to follow through the stages that you have went through, and also your figures and the pen that you have used is clear. So that's basically, guys, your assignment. Any specific questions that I can respond to before I wish you guys well? Is that so? Color is saying, it says no referencing. What I'm sure of is the presentation of 15 marks might not apply to FM3, but it's only safe for one. Remember, when you in an academic environment, you can't be saying everything that you're going to write in the assignment is coming from your hand, isn't it? So just cite your learner guide. It should be okay. It should be just a one line, and we use the referencing using the Harvard format. So one just need to do that. Okay, Carla, FM2, one would have not done that. I'm just saying, playing it safe. Just put one referencing. You know how easy to actually do referencing. Look at, you can actually Google Harvard referencing, or even if you go to your e-learn, you could actually see the best way on how to reference using the Harvard and follow it through. It will be just one line. It wouldn't cost you that much. I just suggest you do that, because you can't be saying all the information that you have is coming from your mind. Ebongani, the presentation, it will be available as soon as possible. I'm not sure will it be tonight, but what I know is by tomorrow midday it should be there. No, we actually still have the same assignment, guys. The one that I've just been reading, that's the one I received, and I don't think there's been any changes to the assignment on your e-learn. Oh, great stuff, Carla. Oh yes, Kai, IMM have done. You're welcome. They've adjusted the learner guide. It's not much, but the reason for the adjustment for the update was to explain the text shield more. And I would suggest go through example 2.7. It actually have got two methods of how to bring in the concept of text shield. So yes, there have been few adjustments to it. I suggest you get hold of the new one instead. I'm sure this video is going to be available latest tomorrow midday on average. So you should be in a position to have it available, guys. Okay, guys, pertaining references, guys, pardon me, me as an academic, I wouldn't write an assignment without referencing. So a one-line referencing using Harvard method wouldn't kill. It's my personal opinion. As much as they didn't say don't, but where were you getting the information from? It's just my personal opinion. So you can still stick to what the instructions are on the assignment itself. But if I were you, I'll just play it safe. You're welcome, Mongani. You're welcome, Eddie. It's a good thing to know that the time we've spent, 1 hour, 30 minutes of your precious time has been helpful to you guys. Welcome, Carla. Welcome, Melissa. I wish you guys all the best. I understand, Carla. Just do it. If I was the one going to mark, not to say I'll penalize you, but surely all this information is not coming from one's head. So I would rather reference. If it was an exam, couldn't find, but an assignment, I will never submit an assignment personally without referencing it. I will just cite, at least in this regard, you don't have a textbook. Just your learner guide. That will be all. You're welcome, guys. I wish you all the best. Go through example 2.7, 2.8, and 2.9. It can give you more insight on how to do forecasting. And the solutions that we have in the learner guide now, they're so brilliant, you're going to benefit that much. You're welcome, Zama. You're welcome, guys. All the best. And what I suggest you do is start to prepare your assignment in time. Once you go through Unit 1, go and respond, type it in if you're going to submit a typed assignment, so that whatever content you've covered, go and make reference to the assignment and see what is there. And then you'll be in a position to prepare your assignment way in time before it's due. So I'll see you guys when we do the second online tutorial, when I prepare you guys for the exam. I wish you all the best. Cheers.